thank you, everyone. I'm really looking forward to hearing the views of our esteemed panelists this morning. And I'm pleased to have the opportunity to set the stage with a few words about why we are actually here. So, cross-border payments has sometimes often been described as slow, expensive, and risky, allowing the private sector to provide better payment and financial services. However, lack of coordination at the international level results in inefficient arrangements for cross-border transactions. Disruption in cross-border payments is emerging with new technologies, and these may circumvent borders and regulations. Ongoing geopolitical conflicts create fears of closed walled gardens, hindering a unified technology solution to address the needs for faster, cheaper, transparent, and more inclusive cross-border payments, especially in emerging markets and developing economies. Recognizing this, in October 2020, G20 finance ministers and central bank governors have endorsed a roadmap for enhancing cross-border payments. This roadmap comprises of 19 building blocks that aim to achieve faster, cheaper, more transparent, and more inclusive cross-border payment services. These services should be safe, secure, facilitate economic growth, international trade, global development, and financial inclusion. Now, the international bodies leading the various building blocks of the roadmap have published consultative and less than final reports offering specific proposals, best practices, and guidance across numerous building blocks. These include reports by the Committee of Payments and Marketing Infrastructure, CPMIs, which provide a framework for central banks, considering liquidity bridges and extending and aligning RTGS operating hours, which is also something that we have heard in the previous sessions. Today, we start to unpack one of the three problem statements identified for this year's tech sprint that was developed in consultation with the G20 members. This problem statement represents a common high priority gap and opportunity where innovative technology solutions in cross-border payments are sought. This problem statement is problem statement number 2. Due to the risk of unexpected volatility in FX rates, FX and liquidity risks can make it more challenging to operate multilateral platforms, particularly if the platform processes multiple currencies. To mitigate these risks, a multilateral platform may opt to settle in a few liquid currencies or mandate participants to fully pre-fund their accounts or choose to settle on a deferred net basis. These choices limit the usability of such platforms. Now, before I further deep dive into the questions that I have for my panelists, I just want to quickly check if we have everyone so I can do a quick round of introduction and actually get started with our line of questions. So,
yeah, thank you. And let's go ahead with Nick and Kelvin, who are here online. So.
Awesome. So welcome, Nick and Kelvin. Why don't I just give a quick 10 to 20 second introduction about you and what you're doing. So welcome, Nick. He has been a transaction banker for close to 2 decades and is currently the regional head of payment products for HSBC's wholesale payments business in Asia. He is passionate about everything at the intersection of payments, technology, and ecology. In addition to his role at HSBC, he also has the privilege of chairing the HK Swift shareholder group, works closely with the fintech industry, and is also an angel investor. Welcome, Nick.
Thank you, Monica.
A warm welcome to Kelvin as well. He is the head of global fund platform of Ant Group. Since joining Ant Group in 2016, Kelvin took a number of leadership roles in global FX treasury solution partnerships teams, where he leads the team in building the next generation global payment and treasury infrastructure and products, leveraging the cutting edge DLT and AI technologies to support the growing needs of small and medium enterprises in a more scalable and sustainable manner. Prior to joining Ant Group, Kelvin was the head of Citigroup Corporate Solutions for China. And previous to that, he was the head of FX for JP Morgan in China. He's an alumni of LSE. So let's get started on the questions. So first, I want to...
We also have Anton online now as well. So he's joined.
Oh, excellent. Welcome, Anton. Why don't I also give your introduction? He's the partner and head of Digital and Innovation Financial Services, lead partner at KPMG. He specializes in business, corporate, institutional banking, market infrastructure providers. Anton has led and worked with over 150 growth projects across corporates and financial institutions, with highlights being sales transformation, digital innovation, strategy, development, client strategy, regulation. Prior to working in financial services, Anton worked on growth projects with corporates. Welcome, Anton. So let's discuss the problem statement for which we've gathered here in detail and explore how banks and technology providers can respond to address this challenge that has been raised. So first question, in examining the existing arrangements across the supply chain in cross-border payments in emerging markets and developing economies, how have some concerns related to reducing FX settlement risk and optimizing liquidity usage have been addressed? A cross-border payment often involves foreign exchange trades to exchange two currencies, exposing both the counterparties to settlement risk. So, Anton, if I could start with you here to help us shed some light on the current solutions deployed to address these concerns, including the deployment of liquidity bridges across the supply chain. Over to you.
Thank you. Thank you very much. And thank you very for joining us. Look, a couple of thoughts to start off with. I think liquidity and the cost of liquidity has always been a perennial issue in our world. We tend to harmonise our regulations and at the same time deharmonise based on sovereign wealth and territorial issues around data. More recently, I think the most interesting developments have been around the use of tokenised assets, tokenised payments, and some of the technologies around blockchain, which promise to actually solve some of the settlement risk when it comes to cross-border payments. I think a lot of this is unproven yet, but certainly at KPMG, we see a movement within the banks and the large providers, some of them being on the line, Ant Financial, for example, to look at the whole of the payments ecosystem from consumer payments through to the back end of supply chains and try and tackle those issues cross-border. So that's one element, I think, is thinking about payments as a continuum, not as wholesale banking, consumer payments, credit cards, and the old ways of working. That's one element. The second element is around data. You've seen the rise of ClearBank and RTGS and some of these payment providers in the cloud world who are trying to do real-time bank-to-bank settlements, atomic settlements. That's an interesting sort of development. But likewise, in CBDCs, the experiments with Partior and the Bank of International Settlements, we see the same type of solutions being developed, the so-called atomic settlement of payments, working in the crypto space. I think it's very much a watch and see. I think a lot of this comes down to regulatory harmonization for a start. A lot of it comes down to the tax authorities actually working much more closely together. So I think, interesting technologies on their way. I'd be interested in what HSBC and Ant Financial have to say, because obviously they're big players in this space. But we need to think front to back. We need to think retail through to wholesale payments if we're going to start to actually solve some of the settlement risk and some of the surcharges that we see on a daily basis when it comes to basic remittances.
Excellent. Thank you so much for actually setting the ball rolling on this. So what I heard from Anthony is that there are a number of technology solutions out there. They are trying to address the entire 360-degree spectrum of wholesale to retail, but we're not there yet. So from the practitioner's point of view, I would love to bring in Nick right now. And Nick, if you could help us understand, as a payment provider, you are actually facing the challenge every day of increasing the demand for support of more and more AMDE currencies. At the same time, you also have a growing dynamic of multilateral and bilateral linkages for cross-border payments as payment providers. So how do you see this growing demand impact your services, especially given the many non-homogeneous kind of solutions that are also being highlighted?
Thanks, Monica, for the introduction, and also IIF for the invitation to this panel. I think firstly, I really like the fact that we're raising visibility, on FX and its associated liquidity challenges, because in general, I think it's a underrepresented topic when it comes to improving cross-border payments, right, across the four goals of speed, cost, access, and transparency. And I do agree, right, with Anton's point as well, we should look at EMD currencies from both kind of the demand as well as the supply perspective. And I'll start sharing some views on the demand side. So I think no doubt there's increasing demand for payments in these currencies. This is backed by our own internal flows. We've seen external report from PIS and many others. And we at HSBC also ran a survey earlier this year called Networks of Tomorrow, and there was very strong resonance from our client base that they are increasingly expecting usage of currencies outside of USD, including many EMD currencies, Monica, that you pointed out. So there are many factors at play, right, including countries or regional blocs such as ASEAN very explicitly promoting local currency settlement. But obviously, a big driver of this is also kind of supply chain resiliency, which we often hear as the nearshoring, friendshoring, or China plus one, right? Take your pick. So as a result, there's certainly been kind of ramp up interest, from our corporate clients on how we can improve support, for some of these EMDE currencies. So Monica, to directly answer your question, I think it affects us across, two or three domains. There's certainly an opportunity to better harness our data as a global bank. We continue to make investments in our product capabilities, and it has also opened up, partnership opportunities. So just allow me a few seconds to elaborate on each. So in terms of harnessing our data, first and foremost, this is a true story, by the way. I was very fortunate to have two brilliant colleagues in my team in both Hong Kong and Singapore. So one was a payment specialist, and another was a data expert. So about three to 4 years ago, they were kind of mining through some of the payments and newly available Swift GPI data. And we were very pleasantly surprised, right, on the depth of the FX and conversion information that was available. And coincidentally, we were chatting to our FX team and we realized that we were leaving some opportunities, on the table. And as you can imagine, this part of the world, there's still a fair amount of origination done in US dollar. But it did point out that a lot of the beneficiary credits were into EMDE denominated accounts. So there was a conversion taking place at the end of the day. So I think the data was telling us certainly something about these flows, right? So that was the data story. Then we had to execute, right? And from again the experience of many people who are familiar with Asia, especially for currencies with capital controls, it does require a fair amount of guesswork or a bit of painful coordination if you're remitting, say, USD into markets like, say, Malaysia, Vietnam, Taiwan, South Korea. So the ability to kind of quote rates offshore from large treasury or procurement centers, say like Hong Kong or Singapore, is very important to remove that friction, right? And it does require some level of product development efforts because, as I'm sure many of you are aware, many of these markets have restrictions, say, from you can't keep, say, overnight balances in your nostril, or again, many of these markets, there's a very kind of rigorous process of physical document checking. So I think the key point here is that these EMDE currencies, Monica, have their nuances, and kind of scaling these offerings does require investment, be it from the bank or other PSPs perspective. And investments in this perspective range, say, from the customer front end piece, how do you digitize some of the supporting document attachments, how do you kind of build new nostril models, or even in our case, putting in place new machine learning tooling to improve, kind of like the predictive logic on when we'll be sending prompts. And I think Anton may have mentioned as well in terms of data privacy laws, certain markets where we need to keep data offshore. I think that certainly adds to kind of the development costs. And just finally, in terms of partnerships, the example I just gave you is where we largely solve it in-house, given the footprint that we have. But I think there are instances where, we needed partners to help plug the coverage. So I think it's fair to say that this demand, for settlement in EMDE currencies, Monica, also opened up a lot of partnership opportunities for us, dealing with fintechs or other specialist payment providers.
Thank you so much, Nick. Perfect time to actually get in Kelvin into the discussion. So Kelvin, when you're hearing both Nick and Anton speak about the many solutions that are getting developed and the many challenges with EMDE currencies and the developing geopolitical as well as other landscape associated with multilateral, bilateral linkages and capital controls on these currencies, and for the markets that we are talking about, how do you actually draw inspiration from what you're hearing, while at the same time look at your own goals of being able to increase market penetration and actually focus on customer experience for end users? It actually creates a lot more challenges for you, both on the partnership side as well as on the delivery side. So would love to hear your take on this.
Yeah, just now, I think this issue being addressed in a more macro perspective. Let me probably start with a couple of use cases. So as you know, Ant Group and Alipay, we mostly focus on e-commerce, serving, I put it broader, serving the digital economy. As you said, the challenge we're facing is actually to serve our users on a 7/24 basis. to have instant liquidities available for them. So the pain point indeed is FX and liquidity. Let me give you a couple examples. For example, for the FX risk, one real thing that we are facing is for the tourist flows. To be more specific, for example, among Hong Kong and China, there are a lot of people traveling in non-banking hour in the weekend, over the weekends. In Singapore, with Southeast Asia, a lot of people traveling over the weekends. And how do you quote FX rate when bank is closing on the weekends? Because these trades, these tourist flows happens a lot more. For example, more than 50% of the volume happens on the non-banking hour over the weekends or the golden week. So this is a typical challenge that we face in the FX. On the liquidity side, is probably more common. For example, we have the tax refund use cases that we normally serve also the tourists. You all have experience go to Europe, right? When you bought things, you get the VAT refund. One way of getting refund is go to the airport, put yourself in a long queue, and fill in the forms, and put on the mailbox. Probably wait for 2-3 weeks, and you get money back or not. And then the other alternatives is actually you go there, get a 7 to 10% discount to get it in cash. Well, we actually develop experience which allow customer to get refund into our wallets, Alipay wallets or our affiliated wallets instantaneously. This will require liquidity on a 724 instant basis. Another example is not for the individuals, B2Cs, but is for the SMEs who actually selling their products on platforms like Shopee, like Lazada, like Amazon. So it would be surprising to know that 40% of their top-up and withdraw activities in those to-be wallets, i.e. the wallets to SMEs, happening on non-banking hours, which is outside of 9 to 6 p.m. and also happening on the weekends. So for those flows, we also need to support them on the liquidity that support them to make the top-up and withdraw. Our approach is actually to combining the data science and blockchain. For the data science, is actually to analyze the data of the customer behavior. By saying customer behavior, we're not going into the data of individual customer, but a collective data of the fund or FX patterns that they're actually showing in their cross-border activities. So by having this data, for example, we will understand how Chinese is traveling to Hong Kong, how the online shopping of Lazada is happening over the weekends. Even on a different categories, for example, cosmetics, for apparels, how people shop, how can people get refund. By having this data, we'll be able to better analyze the FX risk and or liquidity risk that may evolve in a cross-border e-commerce, digital economy activities, so that we can actually offering the FX service, conversion, or a liquidity support for example, for withdrawal of cash from an e-wallet in a more efficient way. For the blockchain or DLT science, actually we worked with a few partner banks like HSBC, like Next Bank, to actually form some closed loop solutions on top of the existing cash pooling solutions that the bank is offering. Together with our data science capabilities, we will enable some kind of co-inventive solution with the bank to allow us to move liquidities around different currencies and around the globe on an instant and 724 basis. Yeah, on a high level, that's what we had been experienced, and that's what we have been working with our partners to find solutions to those questions. Monica.
Thank you so much, Kelvin, because this actually goes and synchronizes very much with the consultative papers that have been put out by FSB, BIS, and IMF, which are actually talking about exactly these risks where the challenges that are thrown up are being solved with the way you have nicely explained, based on some of the use cases where a lot of the data and machine learning has to actually be used in order to be able to predict, because currency controls do not require for free flow of these currencies or settlement even between two of them bilaterally, let alone happening over multiple sets of currencies with multiple central banks having to come in and actually develop these systems and harmonize both the times in which they operate, as well as allowing the currencies to actually talk and operate within each other. And I'm not going to bring up the defamed word right now about our famous dollar, but with these kind of efforts in place, I think the demand that will continue to rise in the market will be about tech solutions to actually help out, instead of central banks and others being able to divert both policy and governance frameworks to help solve this problem, which is exactly what Anton has also suggested earlier. So why don't I actually go back quickly in the interest of time to get your quick thoughts based on what we've just heard. So maybe Anton, I'll start off with you first. In terms of what you see as the future of liquidity management practices, especially given in these kind of markets where we've seen these challenges. And again, just to set the stage and also help everyone understand, there have been so many multi-currency exchange and contracting platforms that are right now being consulted as well as being thought about. And there are bilateral working groups that have been set. There are work streams that are already established. So how do you see this unification attempts and the potential both benefits as well as drawbacks if this kind of unified platform were to come around? And what do you think should be some design factors that should be considered as the implementation steps are underway?
Yeah, I'll be brief because I know we're on time, Monica. But a couple of things. The phrase "closed loop" was used by Calvin before at the mighty Ant Group. By the way, I love Ant Group. I think what they do is awesome. But we've got to think a little bit wider. I think as a series of bilateral and multilateral closed loops. That could be between central banks. It could be between corporate institutions and FIs like HSBC. Think about it more as a patchwork quilt of organizations moving in a similar direction. Having one platform rule them all is never going to happen. It didn't turn out well in Lord of the Rings, and it won't turn out well for us. So I think just chipping away at common standards is a good approach. What I would say from Singapore, at least anyway, is the MAS here working very closely with other central banks to speed up the use of fast payments and common standards across all of the emerging economies. I think that's a really, really good place to be. And I'd actually say one of our best friends out there is actually the whole climate change agenda, because climate change will produce a wealth of data. It'll also harmonize some of our interests, whether it's social or political globally. And so I think the combination of ESG, data, and then technological change on these wider closed loop systems is probably the best place we can be. But look at, again, the institutions sitting on the line right now. They're all multi-region, they're all global. They transcend probably 120 central banks and regulators amongst them. So taking that multilateral approach and building up bit by bit, and using ESG and climate change, and obviously the surcharge we pay on FX at the moment in the emerging to developing economies is a good place to be. So I think bit by bit we'll eat our elephant. But I'll stop there. I know we're on time.
Thank you so much, Anthony. But let me just go quickly to Nick. Nick, given your experience and, of course, your view on the future of liquidity management practices, while we totally, I think, understand that there will not be a one size that fits all and we need to keep chipping away at the problem, how do you see and perceive the future of this landscape and as it develops right now?
Sure, Monica. Three super thoughts to proffer up for you. I think the first, fully agree with Anton's points. I think the way I look at it is that first, you kind of need to unlock more value from the trapped liquidity that's in the system today. I think that's important. There are definitely tech solutions that, and coordination that can help there. But I still feel very strongly that that's not enough, right? I think there needs to be a way to kind of bootstrap more liquidity into the system. And, is that, just central banks taking a step up to kind of introduce more swap lines, right? As a lender of last resort. I think that's something which the industry needs to think a lot harder if they really do want to set up local currency settlement amongst particular trade corridors. So that's the first. Secondly, just a really brief word on technology, and I say this a lot when speaking, say, about pure payments. So from a blockchain standpoint, I don't think technology is going to be the panacea when a lot of these EMDE currencies have very hard issues, right, stemming from some of the points we spoke about earlier, like smallish market size, capital controls, and just very onerous documentation. But what we have learned, from multiple blockchain examples is that I think the fact that you can say technology is not the problem, it shines a lot more light that some of these process, compliance, and the need for central banks or governments to coordinate better. I think that just really, there's nowhere else to hide if I could put it that way, right? And by the way, I'm not a complete Luddite, Monica. I do think there is time and space for us to experiment. I think, with DeFi, AMM principles are certainly worthy experiments. Like personally, I've fooled around with them a lot, and they're very, simple yet, elegant and powerful, but obviously have some challenges to scale in the wild. And maybe the final thing I'll leave you with is that I think Project Nexus, and maybe this is what Anton was alluding to, as conceptualized by the BIS, I think it's a pretty underreported fact that you can actually separate, who initiates the payment as well as the FX providers. Is a pretty unique design. And I think that if that scales, right, where you potentially separate, say, payment for the FX provider, that could potentially be a venue where a lot more FX transactions take place. And maybe it's just another way to kind of solve the problem statement that was described earlier, Monica.
Thank you so much, Nick. Time to bring Kelvin in for his last words on this. But Kelvin, how do you see your own technology, for example, help to alleviate some of these problems that we are currently seeing? And do you see this to be something which is scalable beyond the closed loop environment?
I do see this could go beyond closed loop, and we are actually opening up the ecosystem more and more to external partners. I think in Asia Pacific, we see a good trend of locations like Singapore and Hong Kong. They're actually getting more open on the policy frameworks, on tax standard. The government is driving the policy framework, tax standard on innovation, and also set up cooperation frameworks for banks and non-banks, fintech companies to coming in. I think if I may suggest is that I noticed that most of the project is focused on infrastructure itself, but like probably in the blockchain in the world, they will need some sort of layer 2, which is allow people who actually in the use case to come in to provide the app, the apps, okay, which the infrastructure itself will not be able to create flows, will not be able to create actually applications of these to the real people, to the real small and medium enterprise who are actually doing these things. So we are actually a company quite open and quite like to become the APPs if the infrastructure was set up, that we can actually work on it to make it to release its function and the purpose of designing it. Secondly is we noticed that a bilateral and a multilateral agreement is set up. I think we will suggest this to be more open. The framework, the policies could be set up, but sometimes we found that the commercial terms even be set in a very fixed way, so that for the commercial companies, for APPs to come in, there's not many room for them to actually to operate those things in a scale. So I think my suggestion would be the two. Firstly, to allow more participants to come in to do the applications on top of the infrastructure. Secondly, is actually to have more flexible arrangement to allow the commercial part of things to happen on its own, to form its new format of service based on the new infrastructure. Yeah, that's from me, Monica.
Thank you so much. And as we come to the closing, we do realize that there are a lot of challenges. And of course, we've gained some really valuable insights that are very well synchronized with what we've heard earlier in the day today about public-private participation, collaboration, and of course, technology not being a panacea with a one-size-fits-all solution, but somehow addressing needs and going step by step to actually solve the problem of reducing FX settlement risk and optimizing liquidity usage. However, we have to acknowledge that while there is a need for tailored solutions, the design and implementation of a unified liquidity platform in EMDs demand thoughtful consideration. Forums and panels play a vital role in facilitating these kind of discussions like the one we've had today. And it is essential for us to establish a shared understanding of the problem before identifying effective practices. This panel has made a commendable effort in this regard. Thank you to each of the panelists, and thank you, of course, to IIF EPA for their consideration of hosting this particular panel. And with this, I'll hand back over to Conan.